Most individual investors find themselves caught between two frustrating choices: settling for the average returns of an index fund or throwing their money at speculative tips and hoping to get lucky. The assumption is that Wall Street has an unbeatable advantage. With institutional money, massive research teams, and algorithms trading in milliseconds, it feels impossible for an individual to compete. Then there's Peter Lynch. He grew the Fidelity Magellan Fund from $18 million to $14 billion, averaging an annual return over 29%. His method was surprisingly grounded. Lynch realized that retail investors actually hold a massive information edge over institutions. By paying attention to what happens at the grocery store, the shopping mall, or your own workplace, you spot thriving businesses long before they show up on an analyst's spreadsheet. But noticing a crowded store is only half the battle. Buying a stock solely based on an observation without running the numbers is a fast track to losing your capital. This chart outlines his actual engine. To find what he called growth at a reasonable price, or GARP, you need two pillars: the psychology to hold your convictions and the strict mathematical screener to validate them. The trade-off of this strategy is steep. You have to exchange the easy, hands-off convenience of passive investing for the intense, time-consuming work of verifying your own research. Let's look at the first pillar, the mental model. Stock market success relies heavily on psychological discipline. That means actively ignoring macroeconomic noise. The daily panic over interest rates, currency fluctuations, or the next election cycle distracts from what actually matters: the underlying financials of the company. This rule demands an emotional toll. You must watch your portfolio drop 20%, evaluate the balance sheet, and if sound, hold your ground. Maintaining cash, dry powder, is essential to buy highly rated companies at deep discounts when others panic. It also means walking away from the hype. You have to actively avoid hot stocks in trendy sectors, looking instead for highly profitable companies dominating boring niche markets. If you want to achieve multi-bagger returns, stocks that multiply your initial investment 5 or 10 times over, you must have the fortitude to miss out on speculative bubbles and endure severe temporary market drawdowns. Once you have the psychology in check, you hit the second pillar, the quantitative mechanics. Every observation must pass a strict checklist to confirm reasonable growth. Lynch kept the PEG ratio under 1.2 to capture rapidly expanding profits without overpaying. Finally, historical earnings growth above 15% and high return on invested capital filter out revenue-only hype. The trade-off here is time. This rigorous screening severely shrinks your investable universe, and it demands hours of reading through dense quarterly financial statements to verify the data. But that mathematical screener acts as a barrier against your own biases. It forces you to only buy those businesses that have a proven, documented ability to consistently compound cash. We can map this framework directly onto the modern Indian stock market to see how it dictates portfolio construction. First, you have the stalwarts. These are large-cap giants like LIC and Axis Bank. They expand reliably at 10 to 12% a year and provide vital downside protection when the broader economy struggles. The trade-off with stalwarts is ceiling height. They act as your portfolio's stabilizers, but their sheer size means they will not deliver 10x multi-bagger returns. Next are the turnarounds. Think of mid-cap plays like Bank of Baroda during a recovery. You buy them with incredibly low PEG ratios because the market is deeply pessimistic about their future. The risk is that they become value traps. If the anticipated recovery fails to materialize, the stock is cheap for a reason and will continue to underperform. Then you have the fast growers. These are the small cap companies dominating a niche, expanding at 20% or more annually. This is the primary engine for multi-bagger wealth. Eicher Motors is a clear historical example. By reviving the Royal Enfield brand, it transformed from a struggling commercial vehicle manufacturer into a fast grower that generated massive returns over a decade. Finally, there are microcaps like K-Solves India. These companies represent the highest potential returns in the market, but that upside is countered by extreme illiquidity and the risk of total capital loss. Applying the Lynch framework properly means deliberately balancing your portfolio across these categories. You offset the extreme risks of your high-growth engines with the reliable weight of your stabilizers. So, who is this demanding strategy actually built for? It is designed for the disciplined retail investor who is willing to dedicate at least 5 hours a week to reading annual reports, tracking consumer trends, and running the numbers. If you panic at macroeconomic headlines, check your portfolio daily, or outsource your financial thinking to tips and analysts, this approach will actively work against you. As an individual investor, your daily life gives you a clear structural information edge over Wall Street. But that edge only translates into long-term wealth if you accept the trade-off, doing the rigorous math to verify what you see, and enduring the inevitable volatility to let it grow.